My guest today on believes that Bitcoin can hit 250,000 within the next 5 years, but it may not be for the reasons that you've heard of before. So we're going to find out what these factors are that will lead us to this forecast. Please welcome to Mark Yusko. He is the CIO and CEO of Morgan Creeks Capital Management. He joins me now. Mark, nice to meet you. Welcome to.
No, Danielle, thanks for having me. I'm excited to have the conversation and excited to see where this journey takes us.
Yeah, well, I've been following you for quite some time, and I've been tracking your calls, your latest 250,000 for Bitcoin, but within a 5-year window, which I have to say is not as bullish as other guests who I've had on, calling for that target this year alone.
Yeah, look, what's interesting is I say that the idea that any of us know what the price of any asset is going to be in the very short term is really kind of crazy, in the sense that one of the challenges we have for all assets is the value of something is relatively easy to determine. There are cash flow models for stocks and bonds, and there are dividend discount models, and there are other models for networks, and there's Metcalfe's law and all the things that people have applied to come up with what the value of the asset or the value of a network will be. The hard part is the price, because the price, as I stole a line from John Burbank, the famous hedge fund manager, price is a liar. And price is simply what two people decide to exchange a small amount of any asset for. It has nothing to do with the value. People exchange at low prices when it's below the fair value. People exchange at high prices, well above fair value. And it's like a pendulum, right? It spends very little time in dead center. It's usually too far to the left or too far to the right. Same thing true with Bitcoin's price. It's rarely on the value. And so my forecast is really about the value of the network. And the value of the network comes from the users, from the transactions, from the blocks, and all the things that we can put into a model that say the value of the network,
right,
should be, according to this. Then this is a model that I borrowed, which means stole, because Picasso said, good artists borrow, great artists steal, that I stole from somebody back in 2014. And it basically uses Metcalfe's law to draw a parabola. And it's a nonlinear logarithmic regression, which most of us are really bad at. Math is hard. And long story short, it said it'd be $10,000 in value in November of 2017. Pretty good call. We hit it almost 6 days to the day. But then the price went all the way to 20,000 and then crashed all the way to 3,000. So the price was very different than the value. This same model says the value by July of this year will be around $100,000. And out 5 years from now, it'll be $250,000. Now, what is possible, I won't say likely, but it's certainly possible, that like in 2017 and like in 2013, the price goes much above value in the fall of this year, because individuals come in. And what happens is all markets migrate ownership. The original owners of any asset are investors, right? They buy it because it's below its fair value and they want to hold it for the long term. And then as things start to move, the traders come in, and the traders are looking for things that are moving in one direction or another and have a shorter duration of hold. The problem is when the speculators come in. When the speculators come in, they only buy what's moving, and they really only buy what's moving up, and they use leverage. And so what happens is they push the price way above fair value. And in this latest cycle in December, January, we had some gamblers show up, and gamblers usually don't play in financial markets, right? They usually go to Vegas or gamble online, but because of the lockdowns with COVID, they didn't have any place else to go. So they gambled in the stock market, like GameStop and AMC, and they gambled in crypto. And that's why I think we got a little further away from fair value in the last couple of months than we should have. And that's why we've had this kind of vicious correction here recently. So that's a long answer to your question.
No, there was so much there for me to unpack. So I hope I remembered everything, because it was an incredible explanation here, Mark. First thing, so difference between speculators and gamblers for you is speculators are people not foreign to the financial space.
Yeah.
right? But the gamblers are.
And a speculator actually plays in markets where the expected outcome is not negative, right? Gambling is a negative net present value activity. If you go to Las Vegas,
right,
and you gamble a lot, you will lose money because the house wins. The odds are tilted in the house's favor. And the only way you win in gambling is if you win early, you get lucky, and you stop. That's how you win. And so the same thing's true here is if you got a stimulus check from the government and you had no knowledge of cryptocurrencies other than, hey, that price is going up, that's a gamble that you can buy it and then sell it at a higher price to some greater fool and get your money back. However, if you're foreign to that market, which I love your use of the word foreign, because that's what it is. If you're foreign to that market, you might not know what the triggers are or what happens when a bunch of highly levered speculators, right, again, who do this for a living, start to get liquidated in China. And we see prices fall, 1,000-point candles or, 3,000-point candles. That is a very different environment. And the average, I tweeted about this a while ago. Look, if you bought something because the price was moving up and the price starts going down, you will sell it, right? Because you have no conviction, you have no courage, you did no work. It doesn't make you a bad person. It just acknowledge it for what it is. It's speculation or gambling. If you're an investor and the price of an asset falls to a level that you believe is below the fair value, right, not only will you not sell, you'll buy more.
This conversation of fair value brings to mind a lot of conversations I've had with people in the gold space when we speak of the gold price and it's not fairly valued, it's way below whatever its actual price is. Yeah. So it really brings this to mind.
Well, gold's a perfect analogy because gold, right, for 5,000 years has been money. In fact, gold is money. Everything else is credit. And what do I mean by that? Money is something that doesn't have an associated liability. Currency, which is different than money, currency has an associated liability, government debt. Governments issue currency by issuing debt. So gold has been money for 5,000 years. And to your point, the fair value has been determined by the devaluation or the depreciation of the other currencies over the course of history. I mean, think about this. There have been 775 paper currencies in the history of the world. 3/4 of them no longer exist. They literally went to zero. And the pound sterling, which 380 years ago used to get you a pound of sterling silver, now would take 174 pound notes to get you a pound of sterling silver. So that's massive devaluation. A dollar, which we stole from the Dutch, dollar, okay, was a dollar from 1776 to 1913. And once the Federal Reserve was created and perpetuated this myth that inflation is a good thing, inflation is theft, by the way, it's taxation without any representation at all. It's a wealth tax. And so we've turned the dollar now into 4 cents, stolen 96% of the purchasing power. And that is systematically causing a change in the value of money. So gold, to your guest's point, has been for 5,000 years, 1 ounce buys a fine man or woman suit, right? From a suit of armor to a zoot suit to go to Savile Row or, Fifth Avenue, St. John knit suit probably cost you a couple $1,000. Fine man suit on Savile Row, a couple $1,000. That's where gold should be. So that's why, gold shockingly is at $1,900. And if Bitcoin truly is, and I will argue it is, digital gold,
right?
It has all the attributes of gold as a store of value with 3 superior elements. It's more portable, right? All the gold in the world fits into Olympic-sized swimming pools. All the Bitcoin in the world fits right here. Now, I don't have all the Bitcoin in the world, so don't SIM swap me, but it could all fit there. So it's more portable. It's also more divisible. I don't know if you've ever seen the movie Knight's Tale, one of my favorites.
Yes.
There's a scene where Heath Ledger, Sir William wins the sword and he gets this calf made of gold. And his, squire is in trouble for gambling and he has to bang the calf in half to break it off and says, go do what you do with this. That's a really inexact way to divide that hunk of gold. Whereas I can divide a Bitcoin into, 2.1 quadrillion, which is why my hashtag on Twitter is hashtag 2.1 quadrillion after my name, 2.1 quadrillion Satoshis. So 100 million Satoshis per Bitcoin. So we can put that division of value to a very fine point. And then third, it's less costly to secure, right? Putting your gold bars in a Swiss vault, pretty expensive, pretty bulky. Securing your Bitcoin in a good custodian or cold storage is pretty easy.
But the missing part of that puzzle that the gold bugs would argue, Mark, is the volatility that, yes, has worked in Bitcoin's favor. But if you're looking at it in terms of wealth preservation, and I know you say it's more than a token of value, but if we look at the recent correction, right, and someone who's maybe in their late 70s or 80s and had Bitcoin as a wealth preservation, does that not make a more solid case to own gold?
It's a great try, and I give them credit. But no, here's why. The duration is wrong. So Bitcoin's been an asset for 13 years, right? Mm-hmm. Every year, except for one, the low for the year is higher. So it's actually been a perfect store of value, meaning it has held its value relative to the devaluing dollar.